Okay, let's get started. Welcome to our webinar, and thank you for taking the time out of your day to join us. We're happy to partner again with one of our most popular speakers to bring you the second webinar in our AI series on Trade Artificial Intelligence Using Options, Part 2. My name is Gina Bocais, and I'm on the management team of Regal Securities, which is the parent company of eOption and its sister company, Investrade. A few housekeeping matters before we start. The session today will last approximately 1 hour. We ask that you take a moment to locate the Q&A box on your screen. Please enter all of your questions here throughout the webinar, and our speaker will answer them at the end of his presentation. And to tell you a bit about eOption, we offer you many options for your trading. You can trade stocks, exchange-traded funds, bonds, and mutual funds. And of course, as our name implies, we also offer and specialize in options trading, and we enjoy teaching people how to trade them. We offer you some of the lowest rates in the country, including zero commission on stock trades and ETFs, and options are just 10 cents per contract plus $1.99 per trade. We also offer an easy-to-use trading platform, as well as free trading tools to help you spot trading opportunities. Also, recording of this video will be available on eOption's YouTube channel in the next few days, along with an extensive library of trading videos. So we encourage you to take a moment and subscribe today. If you find the chat box on your screen, I did also put in there a link you can click on to directly subscribe to our YouTube channel as well. And if you'd like to see part 1 of this series on artificial intelligence, you can also find that on our YouTube channel as well. So before we start our presentation, I'd like to walk you through our disclaimer quickly. Option trading does have risks, and this webinar is for educational purposes only and is not considered recommendations or personalized investment advice. If you go to the 4th bullet point on the screen, you'll see that options do carry a high level of risk and are not suitable for all investors. And on there, you'll also see a booklet called Characteristics and Risks of Standardized Options. And if you'd like a copy of that, we're happy to provide that to you. You'll see our email address on there, support@eoption.com, and we'll be happy to provide that as well. So I'd like to turn our attention to our speaker now, Teddy Kekstadt. He's done many webinars for us, and we'd like to welcome him back today. Teddy is a professional trader, and he has over 30 years of trading experience. He traded on the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and Chicago Board of Trade for 21 years and has been an institutional market analyst for over 25 years. He serves as the president of Forex Trading Unlocked and is the author of High Probable Japanese Candlestick Patterns. He has a degree in finance from DePaul University. And without further ado, I'll turn it over to Teddy Kekstadt now. Thank you.
Thank you very much. Now you should pull up. Okay. All right, there we go. I think you should now see the NDX, if you will. That is the NASDAQ 100. As you all are aware, the stock market has been taking a little bit of a hit over the past week or so, especially yesterday and today. And we are now in part 2 of our webinar series on AI stocks. So one thing we want to know is what kind of trend is going on in the broad market. The NASDAQ is the technical stock index, which most of these stocks are traded in, or a part of. So that's why we're looking at this for the broad market direction. So right now we know that this is a bear. So what kind of options are we going to be talking about, and what kind of strategies are we going to talk about? Well, we're going to talk about if you were thinking about investing in any of these companies that are heavy into AI, whether you want to buy the stock or use option strategies. We'll be looking at different things such as puts and calls, which are just direct outright options for direction. We'll also be looking at straddles. When you're looking at those 3 types of options, you're looking for big moves. So we'll be breaking down the different stocks to see whether we're looking for a sideways market or something that's following a trend or possibly a counter trend trade. And then we'll also look at things such as calendar spreads and credit spreads and debit spreads. These are all very basic option strategies, which can help increase your risk reward ratio as you look at trying to break down the different scenarios for the different stocks. All right, so we're going to start with INTC first. Okay, here we go. All right, so we have INTC. This is the Intel Corporation. Okay, so most of you are familiar with Intel, I believe. It's been around for a long time, and especially we know that the chip fact industry is becoming very big once again in the United States. It's ironic how Intel started here and then moved offshore and now is coming back home. Good for America. It's also big for the AI stocks. AI, as you all know, quantum computing and the processing power that is used now is just, it's mind-boggling. It's mind-blowing. And it increases at a rate now that is just, it's exponential every year. So companies such as Intel, not only do they use AI and are incorporating that into their business plan, but they're also part of the moving parts of AI. So if you're looking at other companies, remember Intel is going to be supplying them a lot of the chips and processing components for their AI installations and networks and things like that. So right now we look at Intel. Okay, so let's say that we're going to look at it as, do you own the stock? Do you want to own the stock? Well, if you own the stock, we know that the trend here obviously has been making higher move highs and higher swing lows. So the trend is up. Right now, we're in the middle of a correction. We've had a little bit of a consolidation over the past couple of days. We can see that from the indicators, obviously we're a short-term sell, but overall, the other indicators are kind of evening out, leveling out. It's nothing really severe here. And as far as the daily trade is, when you look at how the NASDAQ has gotten beaten up over the past week and a half, this is kind of reflective in Intel. And it seems like now that it's stabilizing, because remember, indexes are weighted by, multiple stocks. This is one individual, Intel being one of the stronger components as far as when it comes to tech companies too. It's very stable as far as most tech companies are considered. All right, so if this is a consolidation phase, if you were to own the stock right now, you're probably in a good place. If you were trying to protect yourself, if you like Intel for the long haul, then you'd be looking to possibly put on either a put to protect yourself or a straddle if you're looking for a big move. Now, the nice thing that we know is that volatility is definitely up in the options markets, because we have volatility that is up in the broad market as well as these individual stocks. So that component right now is very good for when it comes to certain option pricings and also option opportunities. So if you didn't own this stock, buying a call right now would probably not be one of the things that you want to do. It's in a buying area, but you don't want to pick a top or a bottom. And considering that the trend right now in the overall market is so severe, until you start to see a consolidation there, buying a call probably wouldn't be the thing to do. Buying the stock right here probably wouldn't be the thing to do either. You're probably, if you were looking to buy the stock, you'd probably want to put an order in somewhere below this area here. Remember, you don't want to, once again, try and pick a top and a bottom. So if you don't have a valid signal to get in, giving you a real reason to, whether it has to do with earnings or something new with Intel that you're aware of that just was released coming out that you want to buy into, those two scenarios would not be the best of things to do. Now, one thing you can say is we have volatility. We're now $6 off the high in just 2 weeks, okay? That's a very good significant move. So with that kind of volatility, and since we are looking, let's say that the trend does continue and that this is just a correction, then that means we should come back to up towards this $40 area and take it out by at least $1 or so. That's kind of how the market's been trending over the past, 5 months. So as long as that trend continues, we're in an area where if that scenario does pan out, a straddle would be good, because then we'll be capitalizing on the up move. Also, to the downside, if we're wrong that this is not consolidating and it's the beginning of a extended correction or even a bear market, well, then the straddle is good because you'll have the opportunity to the downside. Whereas once again, with this calls outright or the stocks, you would not have that. Okay, so let's look at some levels here. We're going to pull up Intel on our e-option trading platform here, and we'll pull up for orders. Let's see, we go to trading now. And the nice thing about the e-option trading platform is you have all kinds of different resources that you can use. This right here is when we're pulling up our option ticket. So we have Intel already put up here, and we'll put up some things like this. Okay, so let's look at the market right now. Intel is trading at 34.21. Okay, so there's probably a $35 option, probably not a 34. So let's take a look at the options here. So let's say that we want to buy to open 1 October strike price call. Now we know that the market is trading at 30, right around 35. So we have every $1.50 we can, or every 50 cents we can get in. So we want to have some, since we're trading a spread, now a straddle is where you're going to trade the same strike price. Okay. So since this is at 34.21, we will take the $34. Okay. And we're going to make this really clear on the chart for you. Now, the good thing about this is, remember how we said we're going to show you how, what if you're already long? So if you're already long the stock, this is actually one nice way of protecting your position. Because if, let's say the stock goes up, with the straddle, you'll make money on the straddle and you'll make money on your equity position you already have. If the market goes down, you'll be down on your equity position, but you'll be padding that with profits from your straddle position. Okay, so it's one way of actually putting on a nice little hedge where you're expecting a move and you're expecting volatility to remain high, at least in the short run. Okay, so here we have our $34. This is going to be our strike price right here. Make that really easy for you to see there and clear. All right, so this is our base level. This is our number we're going to use for what we're going to look at for these different trades here. Okay, so now we go back to the e-option trading platform. So for the $34 strike price, and then when you do a straddle, you're buying simultaneously a call and a put. Remember, a call is the right to buy the market. A put is the right to sell the market if you're buying the option. Conversely, if it's the opposite, if you sell the option. So in this case, you're buying a call and a put. And the reason you're buying a call and a put is that you're expecting the market to not stay where it's at. Okay. You're looking for a reasonable move to a very extensive move. Okay. Now we know that this market has already traded down $6 in just a couple of weeks. If it just had a small correction back to the upside, you could reasonably say that it probably would get a good $2.50 to $3 rally. That already puts you in a profit potential for your straddle. And same thing as if it starts to fall apart and make new lows, because since this market has been in a bull trend, if we were to break $3 or $4, well, now you're taking out a previously higher move low. That becomes a trend change. Okay, so that also supports the straddle position. Okay, so that's another reason why we like the straddle versus an outright call or buying the stock. Okay, because right now it's not necessarily the best buying opportunity. You would rather give it some time to buy it lower if you wanted to buy the outright equity. If you hold the equity already, this is a great way of adding a potential hedge that will help you if the market pulls back, and it'll add to your profitability factor even more if the market goes up. Okay, so we see the price here. All right, so to put this trade on, we look at the check here. It verifies that we have buy to open 1 contract INTC of the October 2023 34 call, as also the 34 put. We say yes, there we go. And we now have, for $172, put on a position that protects us and gives us opportunity for this stock. Okay, so now the nice thing about this gives us 1 month's time. Okay, so now we've seen how much volatility in any 2 weeks time, let alone 3 weeks time. You can see this market has either trended extremely, like here it went from 32 to 40, there's an $8 move, and then here it went from 40 back down to 34, there's a $6 move. Okay, so there's enough volatility there, whether it goes to the upside or the downside for the straddle position. Okay, now here's something else we could look at. Since the pricing for that position, think about this. It was $170 for 1 straddle position. Okay, if you were to buy the call and the market was to go down, well, let's see what that would have cost. So let's say we were to get rid of this one here. So it would cost just under $100 to buy the call. Okay, now you have to be right with the call position. The market has to go up before expiration, otherwise you're going to end up losing. Now, you know your risk is only what you pay for the call. However, in that position, you would like I said, you have to be right. And right now, this market is in a buying situation. It is buying a call would be trading with the trend, but you're in the middle of a range where you're not going to have the biggest reward to risk ratio for one. And that's the thing the thing that's really important is you got to think about your risk. You have more risk with the call than you do with the straddle. So the straddle only costs $70 more to give you the opportunity that if the market, as long as the market doesn't stay flat, which in that case, both instruments would have, you wouldn't have made any money on. Okay. But if it does move, don't matter which way it goes, whether it goes up or down. So for value, you have so much more bang to your buck because once again, you don't want to try and pick a top or a bottom. Okay. Now this is not in a situation where we would put an outright call once again or to stock. Now, what about if we look at something like a calendar spread? That's something that's totally different. Now, this is something where you can think about where if you already had the stock and you were long, okay, or if you wanted to get in and you were hesitant about the calls, but you're like, you know what, Teddy, I think you're right. Now is not necessarily the best time to buy into it, but long term, I think like 2 months down the line, I think we have a really good chance of taking out this $40 price level. Well, if the trend is your friend and the trend stays true, then you would put on what is called a calendar spread. Now, a calendar spread is when you sell, you're trading the same strike month. So we would still stick with, in this case, the $34. That was just what we did for the straddle. Okay, so now in this case, we're going to still use the same strike price, but we're going to go down a little bit. Okay, so since we know that this last swing low here is at 32.05. So we're going to go for the $32 strike price. Okay. And this is going to be for the calendar spread. All right. So calendar, oops. The calendar price. All right. So now in this case, remember how instead of buying the stock, because right now is not the best time or putting up that kind of money, but you still think it's a good chance that Intel is going to ride out this short-term correction in the NASDAQ, and then we'll see a bounce over the next month or so. Then that's where we go to our calendar spread. So in this case, you're going to put on two positions. You're going to sell to open, and you're going to buy to open. Okay. So the first thing you're going to do is you're going to sell the front month option. Okay. So in this case, we're going to go down to, what was it? The $32 strike. So instead of 34, we go to 32. And once again, we're going to go now to November, and we go to the deep November. Okay, so 32, we go to again. Now here, this is why you do the calendar spread. This is a situation where now they're both the same. They're both calls, both the same strike price, but they have a different expiration. So now what's the difference between the straddle and the other scenarios? We're trading time. So you want to be long, but right now you think, well, in the short run, this market could bobble around this 34 to 32 for a little while. And that's why we sell the front month call. We're long the back month call, because no matter what, if the market goes up, the calls go up in value because you're long and it's a buying position versus a selling position. However, since you sold the first one, okay, one is going down in value while one's going up. Okay, but that equalizes itself out because they're both the same strike price. So the market going up or down, that value for that doesn't matter to you. What you care about is time. You're actually buying time when you do this. Okay, so each day, the front month option, if the market goes sideways, and even if it rallies, you're going to have time decay on the front month that's going to be faster than the back month. And it's usually anywhere between 2 to 3 times as fast. So think of it like this. If you had something that is worth, say, $2 and $6 as far as value, okay, you're going to see $6 of value disappear out of that front month versus $2 of value in the back month, okay, and that's where you make your money, because you're selling that front month and buying the back month. Okay, so now to put this position on, and this is another very good long position. Now you verify it here. Okay, so this costs 114. So the first position we put on, the straddle, costs $170. This one costs even less. It's $114, and it gives you also an extra month. Okay, so whereas this one, the initial one was in October, gives you until next month for the move to happen. Now you have 2 months of time to be synthetically long Intel because you like Intel, because it's part of the AI space and blah, 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 what have you. Remember, we're focused on who is in this environment, and that means more because of all the growth that's happening in that market. You can see that when in the NASDAQ's getting beaten up pretty hard. Look at the percentage of a correction here in Intel. It's much less in significance than the overall broad market. So this stock, even though the market's going down, and even though this one is technically in a short-term downtrend, it is not going down at that same rate. It is that much stronger than the overall market. So this means this one will hold, will not depreciate as much in the downswing, and is likely to stabilize and actually appreciate even if the broad market is going down. So this is a very good buying situation for our first example. So once again, we covered how, now you can see when we go to account summary, we have our trades here, and you can see that we put them on. So that's the nice thing about the e-option trading platform. When you go back, you can see where your positions are. So now we know that we put on the Intel, we have the straddle, and we also have the calendar spread. So in one case where you're trading this market, where it is a hedge for if the market goes down, whether we're long the market or not. And that's the thing is too, is if you didn't have a stock position on, these are two ways that, forget the equities, you get more reward to risk ratio with these option strategies than you would by having the underlying stock. And if you did have the underlying stock, this would be a case where the straddle would help you. Now, the calendar spread is not something you wouldn't do that. In that case, you would if you were to do a calendar spread, you would be putting on a put spread as a hedge. And that's a totally different scenario. And this is not set up for that. And that is a much more advanced technique. When you're trading it with the trend like this, it's a very basic technique to add to your options trading war chest. So once again, we did a directional trade, was a calendar spread, and then there's a straddle. It doesn't matter which way it goes. Volatility is showing that we should have enough of a move within the next few weeks to get us not only at a profitable level, but get us to a nice target level where if it starts to, we actually could have an explosive move, especially if the index does start to stabilize and gets a bounce. Well, then you can easily see this stock going back to $37, $38, $39. And if it gets challenging that high, that would mean what? That would mean we're coming off a higher move high, a higher move low. See, this is an area where if this stabilizes, that really supports those trades. Okay, so now we're going to go on to the next one. I don't think, do we have any questions in the chat? No, there's no questions in the chat. Okay, so now we will go on to ANET, A-N-E-T. Okay, so here we have Arista Networks. Okay, this is another company that is heavy in the AI space. You can see, just as most of the NASDAQ stocks, that is getting beaten up a little bit. But just like Intel, it's stabilized already over the past week. In fact, look at how it is today. Let's go look at the NDX once again. We see that NDX is on its lows as we're talking right now. It's actually slightly lower than it was when we started this webinar. All right, so in the midst of that, we have a day where this is up. So this right here puts us into that space where, okay, we're looking at AI. That's our first classification. Now we're looking at, is it in a buying situation, a selling situation, or a neutral situation? Right now, we have an indicator down here that has this market oversold. We have overall, it's short term, it's in a correction. However, it's not acting the same as the broad market. While the broad market's getting beaten up and has over the past few days, this market's gone stabilized. It's pretty quiet here. So this, if you own this stock right now, I would say you're probably in a good area. There's no reason to, unless you were in at a very low price and you're looking to see where would you want to put a stop risk in to lock in profits. That's something you could do. But in that case, if you were looking to do that, I would say buy a put. Okay, and that's something you could do without a doubt, is buy a put to protect. You can always do that. If you're long the stock, you buy a put below or at where your stock price is, or around or just below it, and use that as a hedge. So that way, if the market does go down, the only risk you have is the cost of buying your put. Okay, so this would be a situation here where I would say, no, I would look more for the buying situation. So for here, I would say for calls, I would look at, let's first see what kind of a correction we've had here. See, this isn't a great buy zone here. between here, we have 50 and, or excuse me, the 50% and the 0.382 on a Fibonacci basis. Okay, so this is a good area for support. The fact that on a Fibonacci basis, this is falling into this area. We have this market that's oversold, and we also have it going against the trend of the index, the major index. It's a good chance that this market is stabilizing. So what will we do here? If you were looking to buy the stock, great area to probably start to nibble in. However, at 180 some dollars a share, it's going to be a very expensive position versus buying the call. Okay, so now in this situation, you have October to November. I would say you would, because we're so close to the October expiration, we would probably want to have the deeper October. So let's see, if we were, let's see, 177 is the, let's see, what's the low here, 177. So if we buy a call, we want to be in the money. So we want to be right below, at the low or right below the low. So let's see if we got a 177 for the stock. So for ANET, and we're going to, oops, we got to go to, sorry, trading, ANET, there we go. Okay, all right, so we add a position, and now we're going to go to buy to open and just an outright call. So we're going to go for the later October, so one full month till expiration. So for the strike price here, and let's see, what did we say? We wanted to go for the 177 or better. So 177, so 175 would be the call price. Okay, so for this, okay, so for this stock here, now this is something you have to think about. How much does it cost for this one? Now, this is an expensive one. So it's $11.40. So for 1 month out, volatility is high. This is almost $1,200 to put the position on. So we're going to cancel this one, okay? Because for 1 month out, that's not enough of time for us. So let's see if we go out to the November and see what it goes for. And now we'll go to 175. See, the biggest thing about options is you want to look at the value of what you're paying for. Okay, so now this one here, 161, this is just under 1,700. So an extra $500, that's what you buy in time for that option. But still, that's pretty expensive. But let's take a look at the stock once again. Okay, so we know that buying the outright call definitely versus the stock is a much cheaper way to go. Also, right now, with your risk too, that would probably be the way to, if you wanted to outright get invested into this, go with that. Now, because of the pricing here and the fact that you don't want to pick a bottom, I would say let's look at the calendar spread on this one. This is a way of, if the market goes flat or to goes higher, and that's the nice thing about a calendar spread is you can always get out of, if the market stays flat, like the beautiful thing is if it goes nowhere and the first month expires worthless, that's the best thing that can happen, is because then you're long a call. Because remember, in the calendar spread, you sell the front month, you buy the back month. Okay, so if the front month expires, okay, like in this situation, if we had the 177 call and the market, let's say, was at 175, or sorry, 175 was the call we were looking at. So if the market trades down below 175 at expiration and you have a calendar spread on, well, the one you sold, you want to expire worthless, and then you still have time for the bounce and for the market to turn around if it truly is a good long play, you know. So we'll look at the pricing on that. So we see we had 175 was a strike price that we're talking about. And so for this case, we need to add an option. So this would be a sell to open. Oops. Sell to open and a buy to open. And we're going to look at the November. And we're going to look at the October. Okay, so now we go to the 175 strike price. Now remember, a calendar spread, we're trading time. So if the market goes nowhere, now this is $500. Big difference then from, remember when we were looking at the outright call was going to cost just under $1,200. And if we were to do the other option, the further out option, it was an extra $500, it was just under $1,700. And that would just be the 175. And let me get this to 175. this so you can see it and change the color. So that one there, we'll get rid of this so it's clear. This 175 strike price, if this market settles below 175 sometime before the first one, which remember, this is an October expiration, if it goes down there, that's the best thing that can happen because you're selling that option to begin with. You want that one to expire worthless. And then you still have the call that expires all the way out here in November, all the way at the back end of November. So that gives you all this time to round this out. So we're going to look at the price on this once again. $504 means that you are selling the time, you're trading the long situation, and you have the potential where you could still capitalize on the going sideways in the interim where the market's getting beaten up, wait for that consolidation, and then you can either get rid of the the one that you can buy back the original call, okay, or you can the front month call, or it expires worthless if the market falls below 175, and then you stay long the other call because you have until November 27th on this one. So this one here would be a good options position for trading ANET. So once again with ANET, we have the call situation, not quite yet the place to go, and especially with the pricing. It is a very expensive option to, unless you have a real valid reason. If this market had been beaten up a little bit more, like for instance, let's say, because I told you we are in a good buy range here for if it's just a short-term correction. If the market was trading, say, down here or a little bit lower, this would be an area where I would say, let's look at a call. But there's no reason to look at a call right now because the correction isn't that severe. Volatility is still heavy in the marketplace. And remember, you're not taking a counter trend trade for the stock because this market has been doing what? It's been making, here's a low, here's a higher move high, higher move low, higher move high, higher move low. That means it's indicative of a bull trend. The market is trending higher. So you're taking a trend trade with the calendar spread, okay? The outright call or buying the stock, it's not in a good enough area or giving us a reason to show a true buy signal, especially because the broad market is being depressed. As long as the broad market's being depressed, you know that it's going to be tough for this market to see a lot of upside potential. But the nice indicator is that this one, especially on a day to day, where the NDX is making new lows, which it's been trading lower out of the last, look at it, had one up day out of the last 5 trading sessions. Okay. Now we look at ANET, and out of the last 5 trading sessions, it's had 3 up days. It's basically flat and it's higher today than it was yesterday. So that's giving us, once again, a good indication that this stock has value for the long side. There's no reason to play the downside. So far we have 2 good stocks in a depressed market that actually are very bullish for strategies. There's not a lot of potential to the downside for and like especially like with a put, if you were to put a put on in this situation right here, obviously this market may have room to go to the downside, but you're more likely to see it come down a little bit and spike, and who knows how fast this market, you can see how, look at this swing low. This market went from 148 all the way to, let's see, it opened at 177. That's a big gap. So this market has the potential to gap around in big moves. So if you're going to trade, or you have to be cognizant of things like that. So besides having volatility, this has the potential to gap so huge in pricing between close and open of the following session that outright call positions aren't necessarily, or outright put positions could be very dangerous. Just like an outright stock long position could also be dangerous in this particular stock because of the volatility. But when you start to put on straddles and strangles, that's a totally different story. Another thing we can look at once again with this one is we look to buy to open, and we go to October 27 on both. We stick with the 175 strike price, and we do a straddle on this one. Now this one gets very expensive. Oops. Oops. Put call October 27th. Buy to open, buy to open. Yeah. Oh, wait, that's right. We already have a 175. So we'll, you know what we'll do here? Since we don't want to interfere with that, 175, we're going to do a 180. Okay. All right, 860. So we do look at the 180. All right, so if we were to put a straddle on, and put it at the, let's say 180 level. Sorry about this. There we go, 180 level. Okay, we take this other one out. Let's make it easier. Okay. Okay, there we go. All right, so if we do the straddle at the 180 price, okay, what kind of a move do we need from this one? Now, this is expensive. Remember, we looked at the calendar spread, it was 1,500, it was 500, just under $600. We were looking at the different call scenarios. Now we have a straddle scenario, which costs almost as much as it did for the one call scenario. The one good thing about this is if you have a nice move, you'll be able to realize some nice profit. But the cost of the straddle, though, is very expensive for 1 month out. You're looking at $1,600. It's just too expensive for this because you would need to have a move that would justify it. I mean, this market does move a lot, but look at how much the broad-based index. Right now, you're in a consolidation phase. Remember, if you put a straddle on, you're looking for a large move. Okay, you don't want the market to stay stagnant. Now, is this market, did it bottom? We're not going to say that it did. Is it going to go back up? Is it going to stay where it's at? It could. Right now, considering once again the broad market is going down, this one is stabilizing. This could be set up for a range trade. If that's the case, you're going to get buried on a straddle. Straddle is when you see there's high volatility and a real likelihood of a lot of movement. If you look at this, the range that this has been in for the past few months has been basically from where a little bit lower than where it is now, from 175 to 190. That's a $15 range. It's not enough for the expense of that straddle, especially for 1 month out. You would need to have this market move from, it would have to go above 195 or it would have to go below 165 to make sure that you are breaking even just at expiration. So there's not a lot of potential. Like, you would have to have a significant move way before that to realize any profit potential. Okay, so this is a situation where, unlike before where straddle worked, where we wouldn't put this in with this one. Okay, now let's look at another position here, RELX. Okay, this is another AI company here. All right, let's see what we have going on here. Now, this one is following the NDX. We can see NDX has been breaking. It's breaking pretty solid and hard here. We go back to RELX. Just like it's getting hammered today, so is this. So what does that tell us? Well, we already know that this market is in a slight bull trend. It's making higher move highs and higher move lows. It's coming off of a higher move high, and obviously we're retracing. So how low can it go? Well, it's already in a good spot as far as retracing. The 0.50 to 0.618 Fibonacci area is usually a good correction zone right in here. So, but look at this. The market is barely even oversold. Right now, it's just coming off of way overbought. So indicators are always lagging. So it doesn't mean that this indicator here means that this is going to continue to slide for the next week or two, or even 2 months or anything like that. However, the basic indicators right now are saying that there is room to go to the downside. The trend, once again, is up. So this is viewed as a corrective move. So we're looking for it to not come below this $31 area. Okay. This would be our major risk level right here, 31. So let's make this clear. Okay. So if you wanted to buy this stock, it looks like you kind of want to wait for the NASDAQ index itself to stabilize, just because it seems that when that starts to trend either to the upside or the downside severely and volatility increases, this market, this stock tends to seem to follow through in tandem with that. Volatility obviously is increasing, so that's a good thing. It means you're going to have potential market action. That's nice. Now, as far as direction, once again, do we want to say that this market is going to really be the same as the overall NASDAQ? No, but right now, short term, it is under pressure. So buying the stock would probably not be the best idea. If anything, you would look to buy it somewhere at this 32.74 area or even a little bit lower. Okay, that would be if you're looking to buy the stock. You can see the range that this stock has been in also for the predominantly is this is the area down here where it pretty much stabilizes, then comes back up. So this is a very range bound type of stock, even though short term it's been in an uptrend. This is something you need to be cognizant. So of if you were to buy the stock, then you really need to buy it down in dips, and it's not low enough for the way it's been trading to even be where you want to go. You would want it to actually come and take out, be right around this 31, this area here, but just above $31 to falling below this line here and below $31. That would be your range to look to buy, especially if you're looking for an investment. Okay. Now, also, if you're looking to buy calls right now, not the best situation because odds are this market's going to break. So any calls you buy, you'd have to buy lower and then you'd just be losing time. So buying calls outright, not exactly the play. Puts, you've had a big move already. This is a buying area. So if you own the stock, then this would be a situation where you might want to buy the put. So let's take a look and see what it costs. So for RELX, okay, so we're trading at, what is it, 33.19. Let's see what the, okay, there is a $30. Okay, so there's a big, yeah, see, there's a lot of volatility. Now, here's something you have to watch also. So the bid and the ask on this option is $1.40 at 590. That is a very wide spread. So when it comes to buying a call in this situation, you're paying a very, very big premium. Okay, if the spread was only 50 cents or even at max $1, probably wouldn't be such a bad option to start to look at for different strike prices, but especially for one that's, once again, you're looking at the $30. That's down here. So let's go to the 30. Let's see what else we can do here. If we look at the 35, let's see what this is. Okay, well, now this is another one where the bid, this is too wide and it's not liquid enough. So in this situation, an outright call is not a good opportunity, especially since we have all the reason to believe that as long as the broad market is still making new lows and on its lows, and indicators, even though lagging, are pointing to more selling, a call is not the situation to buy right now. The put, we can look at that. Okay, now this one, it's a wide spread there too. So the $35 put, which is above the market, that would be, see, that's all the way above there. So let's see if we go to the, and then 30, this is one where it's below the market. Yeah, the put situation for RELX, and this is why you always got to do your breakdowns of what you're looking for. That would not be the scenario to do here. Now, what would be here would be a calendar spread. So let's look at we got the $30. So let's see if we do the October. Okay, if we do look at the calendar spread. Now, once again, this is where you're trading the same strike price. Okay, now remember how expensive it was to trade there was a big risk bid ask spread between the option pricing for the other things we looked at for this. So right now, if we look at a calendar spread and we're looking at the $30, which is down all the way down here, it's cost $460, just over 460. Now this is the trade for this one here. Why? Because you're buying time. This is a situation where you like RELX, okay? And no matter what, over the next 2 months, 3 months, you see this market going higher. The best thing that can happen right now to this is it goes sideways or actually comes all the way down and maybe even makes new lows. If it takes out, let's say this market, the NASDAQ, continues to get beaten up over, let's say, the next week or so. Let's say we just have a meltdown in the NASDAQ. We know the call positions here were very, very expensive. You're way above the market. So because of the limited liquidity of options for this one, remember, not every AI stock, some of these NASDAQ stocks are not as liquid. They don't have as much trading. They have volatility and their stocks have liquidity, but their options don't. Okay, just because of the volume, they don't have it. In this situation, you trade accordingly. And you also, this is where option pricing comes to help you out. So we like the AI, we like RELX, okay, in theory. So call, we can't do. Straddle is not a good idea either because you're so far out. Can't do that. That won't work. But the calendar spread, that totally fits our scenario. One, because we want the market to be stagnant or to bullish. And the best thing is we're selling the front month option so that we want this market to go down so that our front month call, our $30 call for October, keeps on decreasing in value. We can always buy that back and sell out the other option, and we'll make money on that trade because remember, the pricing is going to be there, you know. So when you have, once again, this one here, 464, so that's the $30 call. So now in this scenario, you want it to come down. And the best scenario is that it comes down and close to expiration, say it's trading between 31 and 30. That's where you would buy back the front month call. And then you can sit on the other call because remember, you wanted to be long this market and you own it. If the market comes back to especially above this 33 area, you're going to be in a good spot, you know, because you remember it's a $30, it's a $30 call. And let's look at the pricing here. So we have ANET. Oops, let's go to positions. I'm sorry. Okay, so now we pull up ANET spread here. Okay. Where do we do this? ANET spread. Okay, this one's in here. Oh, I'm on the wrong one. My bad. Okay, so yeah, so it was 460 for the spread. So our pricing here, we know that at expiration in November, so you can withstand a market dip or just sideways, whereas if the market is where it's at or even remotely lower, you can buy back that original call that you sold because it'll be worth a lot less, and then still stay long the other call because it goes all the way to the end of November. And then the whole spread cost you 460. So you would have already made money off of the first option, okay, which is padding the other one, and then you hold it out. And if it's 460, you're looking, if it went to $34.60. So if it trades just below these highs right here, that call at expiration will be worth what that whole spread cost you, but you will have already made the money on the front option that you had sold. Okay. And if you get out of it beforehand, or let's say it takes out the highs and goes to $35 or something like that, well, then you're golden. And then you have the choice of, if you wanted to exercise the stock, the November option, and because you'd be long at 30, and if the market's trading at $35, $36 or something, if you have that kind of a breakout, then you would be long the stock you originally wanted to buy, but was not in a good price point to buy like it is right now, because right now you don't want to try and catch a falling knife. So it's a good idea to weigh your options, no pun intended. So we looked at what scenarios did we not do? Buying the stock right here, not a good idea. Wait to buy it a little bit lower. Put either buy orders in lower or what have you. If you own the stock right now, the only real hedge you have would be a put, and that's a dangerous one because of the legs. So with that one, I would say, once again, you're probably better off putting a stop in for that and just taking your hit on the outright stock. But then once again, you're losing a lot of money on that. So if you're already in it, there's nothing you can do about it. You have to conserve where you're at, your position. So don't get in right now if you're thinking about it, and obviously put a stop in if you're long, or if you want to participate. We know no calls, no puts, no straddles, calendar spread is the way to go because you're buying time. Remember, the whole object of trading is not about really so much what you trade or whether the markets go up or go down. You just want to be profitable. Putting on positions that cost a lot, that yield incredible returns. And then there's positions that cost a lot that really that is your risk, is the cost of the position is super huge and your reward is very small. You know, you want to be making 2 to 3 times your return. So, and once again, when we're trading calendar spreads, even if the market doesn't move, you're getting 2 to 3 times decay on the front month. Which is what you want. You want to have that kind of earning potential, you know, because everything else will neutralize on the back leg of the option spread versus the front leg if in that scenario. So the calendar spread, once again, great idea for that one. All right, let's look at one more while we have time here. All right, now we're going to look at Taiwan Semiconductor Manufacturing Company. All right, well, this one, talk about not trying to catch a falling knife, huh? This one is, let's see, NDX. When did NDX turn? NDX turned on July 19th. Okay, that's July 19th. And now let's see, TSM. And this turned on June 13th. So this has already been in a bear market for a while. I mean, you can see lower move low, lower move high, lower move low, lower move high, lower move low, blah, blah, blah. So what do we do with this one? Well, in this scenario, it's tough to say you want to buy it. Right now you're in a bear trend. To buy this market is a counter trend trade. If you really like Taiwan Semiconductor, overall long-term call situation, it's a tough one here because your indicators are oversold, but not totally over. They're not buried there, but they're also lagging. The reality is this market has continued to make lower move lows and lower move highs, and especially as the index has been sharp over the past week and a half, this thing has gone from, 90 to 84. So it's had a nice, it's at just there alone, it's had a nice percentage correction. So I would say buying this stock, you need to wait for a reason to buy it, a signal. If you could say that you're scaling down, but that's not the way to start out in a position. Let's take a look at the weekly real quick. Okay, so this market, yeah, it's an overall bear. It had corrected to the upside, and this recent turn is just a sell-off here. So this is a bear market situation. Okay, so this tells us now we can do something totally different. If you own this stock, now for sure would be a time to look into buying puts. So let's see, the market's at 84.88. TSM. Right to open. October. 84, 88, 85. Put. Okay. This would be right here, the $85 put for just under $300. This is your trade for this one here. Oops. Buying the stock is not right. If you own the stock, that would be what you want. Because for $300, and you look at it, we just saw it on the weekly basis, you're golden. Why? Because for $300, look at this volatility. It doesn't have to fall very far. It doesn't even have to make it to $80 over the course of the next month. And it's a trend trade. So if you own the stock, the put would be the way to go. Okay. And then also, if you didn't own the stock, then let's look at the straddle. Okay. Now this is 625. Let's see if we can have that kind of a move. 625. Yeah, I think we can. Let's see. $6 move. It's had a $5 move in a week and a half. So a $6 move on that. That's at least what we would need from there. If we have a correction, we'd hit 3. So yeah, so for a straddle for volatility, if you just wanted to participate in this, a straddle would also be a good trade here for $631. That gives you, if the market continues to tank, you're riding that trade. And if it gets a correction, which it is overdue for a nice one, even here, you see that it went from 89 to 96. That's a $7 move. That is more than what we need before expiration. In fact, if it goes that far at expiration, you'll be doubling. You'll be making twice as much as what it costs. You'll be having a $1,200 position out of that one. So especially if it happens within like a week or two beforehand that you can exit it. So those would be the two trades. That would be the only type of long situation I would say is if you put the straddle on. Now the calendar spread, we can look at this one, which is a sell to open. And we'll look at the November, and we'll look at the 85 puts. Well, yeah, there's nothing here. There's no VIG on the calendar spread, although it costs next to nothing. Well, here's another one. You could put the calendar put spread on at 85 strike price. The 85 strike price here, and actually what you'd want to do is not do 85. You'd want to go one more above. You always want to have some kind of meat on the bones. So yeah. Okay, so in case there's a, yeah, this would work. Okay, so this one here, for a net debit of only $70, you could put on the calendar spread for the $90 strike price. That's cheap. So for that one, that's worth riding the sideways to bearish trade for this market, TSM, Taiwan Semiconductor. So we went over 4 AI related stocks. We looked at different option strategies you can use, when not to use certain ones. Obviously, whether you buy the stock, if you own the stock, how to hedge the stock. We went over straddles, calendar spreads, calls, puts, showing how the pricing and the scenario would be more indicative of which position in different cases. You don't just put the straddle on in every market, and it's not always the same scenario. You have to see how things line up, and then make sure you have the risk reward ratios there as well. So we had some nice examples, and I don't see any, let's see. Yeah, there was no questions on the chat. So thank you very much. And now I will turn this over to Gina.
Okay, great. Well, thank you so much, Teddy. That was very interesting and informative. And thank you to all of our attendees for taking the time out of your busy day to join us. We greatly appreciate it. And just a few quick reminders before we go. If you look at the page in front of you, we do have some wonderful e-option resources for you. We charge some of the lowest commissions in the industry. So it's just $0 for unlimited stock and ETF trades, and options are just 10 cents per contract plus $1.99 per trade. We also have a very powerful and easy to use trading platform. And if you use our free trading tool called Options Play, that's worth over $500 annually. And that is free to all of our customers who open an account with us. And there is no minimum to open an account. If you are interested in learning more about options trading, Teddy used eOptions paper trading platform in this presentation. So if you'd like to just poke around our trading platform and give it a try and test out your option strategies risk-free, feel free to do that. If you go to eoption.com, you will find on the homepage a sign up for our paper trading platform, and it takes just a minute to sign up. So if you're new at options and you want to try some of these things that Teddy was using, like calendar spreads, it's an excellent way to get started and try out some of your option and stock trading strategies. And another great resource that we have that is free on our website is we do have an option strategy page. So if there is a strategy that Teddy talked about, or you're wondering an option strategy you'd like to learn more about, you can just click on the strategy and it'll show you a video and it'll tell you why you would use it and give you more information. So we do have some excellent resources at eoption.com, and we hope you'll take a look at it. And we're also always here to answer your questions at eOption. We do have an email address. Our customer service team is at support@eoption.com. And again, if you have any additional questions after this webinar, feel free to give them a call, or you can also email them, and you can also give us a call at 888-793-5333. So we're always here to help. We love educating people about option trading. And it is something you have to educate yourself before you do. So we're very interested in that, and we do want to help. And we also, a recording of this webinar will be available soon on our YouTube channel in the next day or two. So make sure you subscribe so you don't miss any of our videos. Again, that's youtube.com/eoption. And for those of you that don't have an account with us yet, we will have a free stock promotion on there in the description under the video. So make sure you click on that, and we'll have a gift for you if you open an account. And it is, I believe it'll be good for just over a week. So you'll want to check for that. And we will have a few more webinars by the end of the year. So we hope you'll continue to join us and learn with eOption. So in closing, thank you again for your time, and have a wonderful afternoon. Bye now.